ATFX and Investing Cube. We're gonna take a look at the markets as we usually do this time of the day and see if there's anything interesting to trade. And it is summer, so it's much harder to actually. Okay, good. It looks like we should be back live now. I think I had some connection issues there for a few minutes and I got kicked out. Let me just see that we are indeed online. Okay, I guess we'll just have to see. All right, so let's begin. And we're going to take a look at the markets as we usually do, as I just said. If you're watching this live, you're most welcome to say hello. We have Marvin there. Good morning to you, sir. I hope you're doing good. And anybody else that wants to join and say good morning, you're most welcome to do that. You just need to sign in via YouTube, and it's free to have one of those accounts. Allows you to follow accounts, allows you to like and comment and ask questions. So if you have questions about any market that you're trading or anything else that you might be interested in, then this is the time to put it here. And then if I see the question before I finish, I'm going to be able to reply back to you. As well, if you arrive later or late, you can always just pull things back like that. And that will give you you'll see the presentation from the beginning. Good, so it looks like we are live now, so it should be all right. Awesome. Okay, good. So let's begin then. So we're going to begin by taking a look at our old friend, the euro dollar, that is not doing anything. I'm laughing, but I shouldn't be laughing. This used to be my bread and butter for many years. I used to trade this, and I made some decent money trading this one because it was rather easy and it was going somewhere. But really, since last year, it's not going anywhere. Now, this is a big Andrew's pitchfork that I've been talking about for quite some time. And a few days ago, when the market was trading down here, I said the pitchfork sort of indicated that we're probably going to try to trade lower. At the time, I don't remember exactly if we touched the pitchfork, but looking at this now, we hit that pitchfork more or less. The market's moved down to what we call the median line. The median line is sort of the midpoint of that trend, and we don't want to be selling in the midpoint of that trend, and we do want to sell because overall the pitchfork is pointing lower and not upwards. However, though, as you can see, you know that the market and people bought here in August 1st. They lifted the market up, and the RSI here on the 6 hours slightly oversold. So again, reward ratio wise, RSI wise, and Andrew pitchfork wise, it's not a good time to sell. If we do go up to the upper end here, I think that could make sense to short sell. Probably stop loss orders. I think most of them, they're going to be placed at 12.94 up here. Now, if I just clear everything out, you can just look at this one. So this is just a pure chart. So you can still argue the same. This is resistance and probably stop loss orders here. Some people probably going to put stop loss orders bang up here. But I'd rather work with this one up here. Only at the same time, you can see we're rather close to the low. It's probably not the best time to short sell. You say then, so maybe I should be buying then. Well, you could if you wanted to. However, I would strongly advise against that, just because we're not close to the lower end here of this green space. But more importantly, we're not in a downtrend. And in a downtrend, it's really important just to sell and not to buy. Doesn't mean that you can't make money on going against the trend, but it's far harder, and mathematically, you'll see that there's less pips to be made. All right, this is the GBP versus the USD, and here the situation remains bearish. There's not a major change here to the outlook. A few days ago, we moved lower. We touched this level, which I discussed yesterday with you guys, which was the 27.6 level, and then we were on our way to 2050, but then the market moved to the upside. You can see a strong little push to the upside, and it's sort of telling us that maybe we have found some sort of a low here. But the way trends work is that they are bearish in this case until they're not. When and if they're gonna change is really difficult, and I don't even try to guess that. But I definitely try to sort of look at what are the important levels. I also do look at the price action, because I don't have to trade this market. There's so many other markets I could trade, and where the setups are better. So what's one reason to be very careful with short positions here? Well, you have yourself a major low down here, and you have yourself a major left and a major right shoulder. So this could be what we call a head and shoulders pattern, right? And if we trade above something like 2182, we're going to be dealing with an uptrend. And the market could, we could be dealing with that, the triggering of this pattern. And the difference between this low here and this high here gives you a target of 123.64. Now, we're probably not going to, I wouldn't get all excited about this specific level here though, which is the 2180 level. Rather, I would combine it with a horizontal level of importance, which is the 122.12 level. As well here, we are still in a downtrend, even though this market has creating this sort of pattern. So we should, technically, we were not allowed to go long. I'm not allowed to go long here with my system. Maybe only, only on a break to 112, 122.12 does become interesting. Here's your dollar yen. So dollar yen is moving away. So we talked about selling here over the last few days. So it moved a bit to our favor. I think the first time it moved to our favor, it did that. And then it went back up again, moved to our favor again. Well, did make some changes though. The first sell zone was here. And when we were out of that sell zone, I said, probably push this up again. And we had that attack. And now it's back up again. Again, this is a bit of an issue. Again, it's sort of indicating to you a little bit that when the price goes up and goes up and goes up, that's not one trade lower. That's again a warning sign that maybe we're not dealing with some sort of a low here. But again, here we just need to be realistic. Is it gonna break that high? Maybe. What could cause that then? Well, we have the Fed minutes coming up. We have also the synopsis, the Fed synopsis, and I can't even pronounce it today. But that big gathering that they have once a year. And what's happening here is that they might hint that maybe the market is too bearish. I personally think they're a bit too bearish, the market. And obviously, if they would hint about that, and you would indeed have a major sort of turnaround, that could easily cost the dollars a gain. I personally think people are a bit too bearish, but maybe I'm wrong. Trend-wise, though, there's no major change here, and if you look at it from the bigger picture, I still think people are quite keen on selling, just at higher levels. Now, moving along here, crude oil, just trading sideways. I have a guy, he watches these videos, and I put my lines in the sand, like these are the levels. And when I think the market is starting to trade sideways, like it's doing here, there's no change. So there's no change here to this outlook. It's neither bullish, it's neither bearish, it's converging, and it will probably not trade much higher or much lower until we have a break of these highs. So I would just wait, and until we have these breakouts, there's absolutely nothing for us to do. Gold prices. So gold prices bounce from this little buy zone, and if you're really bearish, you could probably get involved here if you wanted to. Stop losses will go down here. I'm also, bearish on the world economy, that is. I'm also bearish on the world economy, but for me, I'm looking for a better corrective level. So maybe here from 1457 or so down to 1440, I think would make sense. German DAX. Oh wow, look here, it's rather bullish today. It's still technically bearish on the daily chart. So if you look at the daily chart, we're still dealing with a downtrend here. You have lower and lower highs on the daily. And the market is now trying to challenge that important level, which is 11,860. And I think if we do take out that level, the market will obviously stop being bearish, and then we maybe head up to maybe something like 12,200 or so, and then we'll just need to see what happens. But this could be the creation of maybe something like this, or something like this, or something like this. So it's also, if you look at it from this perspective, maybe the beginning of a bit of a head and shoulders with head, left, right shoulder. So we need to be very careful here. Now, as for the sell setup, we need to stick with the trend until proven otherwise. Until we take out the August 8th high, there's no change here. It's easy to get a bit of panic when you see these sort of situations. And if we do take out the high, then yeah, we will not be dealing with a downtrend anymore. But until we take out the high, we are dealing with a downtrend, and it's more important to stick with that than to change our minds halfway. As for the S&P 500, it's moving slightly upwards, right? So the market has peaked around 29.41 on August 8th, August 13th, and August 20th. And maybe the rhythm has changed of the market. Maybe we'll head up higher. But the best idea has been to buy at the lower levels here, as we mentioned to you guys. And we might just go up here and then stop. And then that will be the end of it. So I wouldn't get too excited, but if you are scalping, maybe the little break here could open up for a tiny little move to the upside to 29.68. But then you have these levels up here, and I do think that people will probably try to short sell, if anything, up here. So maybe you can scalp that little section, but I don't really think it's going to be easy. My preference is just to wait for a dip. And I have a strong feeling, much like I had for crude oil prices, that we will continue to trade sideways here, I think for at least maybe 4 weeks or so. Fed rate meeting, I think it happens on September 18th. And what else? When is that ECB rate meeting? Let's see here. Yeah, it's the 12th. So the 12th can be a big day. And then 1 week later, on a Wednesday, you have the Fed rate meeting. So realistically, we'll trade sideways, and we'll see what happens afterwards. Government bond yields in general, like, let's see if I can find them here. So the US government bond yield is a 1.60. So if the US government, if you lend them money for 10 years, you get paid 1.6% per year if you would buy a government bond yield today on the second-hand market. Look at, say, German yields. They're minus 60 the last time I checked. See if I can find them. I found the 10. This is the UK one. Is it a 0.5%? 48 basis points. See if I can find the German one. That's not the right one. Negative 65 basis points. So obviously people buy these bonds because you can make money on just the price change, right? And why is it declining? If you think about it, why is it declining? Because of QE, right? So most likely we'll do some sort of QE, inflation is going to be low, or we're going to have a recession. German economy is already really weak, as we know. So what's happening here is that the government bond yields are all going down, down, down ahead of that event. What this also means is that the government can today borrow money at very low interest rates if they wanted to, but this is also linked to corporate government bond yields. So, and what is interesting is that usually there's gonna be, obviously, it's not always gonna be exact, but this can act like the reference rate. So it would be maybe maybe it would be like, so it's a negative 65. So then they'll say, okay, so you need to pay this plus 200 basis points. So then they're borrowing for maybe 1.5%. Now I don't remember the actual name. I haven't actually focused on that too much, but there's obviously a benchmark for corporate bond yields in Europe. I know the ones in the US, but I'm not sure what they're called in Europe. The key point is this, though, that all these key benchmark interest rates are really, really low. So for people, corporations that want to borrow money, governments that want to borrow money, student loan, mortgages, all of that, it all sort of becomes really cheap. And the idea is that you might have, where's money going to go and be parked? If you park your money in Germany now, you're going to lose 65 basis points per year. So what are you going to do? Maybe you can put it into a government bond yield, or like stocks, most likely stocks, really, that will pay you some yield and dividend. And that's probably what people are going to do. So this by itself creates a big stimulus for economic growth. So if we don't have like a further slowdown in the economy, stocks are suddenly going to become really, really attractive. My personal view, though, that we will probably have further slowdown. And for now, at least for the next few months, it makes sense to be bearish. So if stocks, if they would break lower, that would not surprise me. But we need to make sure the timing is correct, because the timing when it comes down to trading stocks on the bearish side is really, really important. As you also might know, we talked about it yesterday, the likelihood of recession is rather high. And then again, that sort of points toward lower stocks. And then as everything in life goes in cycles, so what might not be a great opportunity or great situation now, well, if stocks go down with 30%, then suddenly, things look a bit different, right? And maybe you actually want to be bullish despite it being a recession. In fact, we're going to see if you guys have any questions, but in general, I'm going to see if I can load it here. In general, I'm going to see if I can do an overlay. Let's do a monthly chart. Just to give you an idea here. So this is the US unemployment rate. And we're going to do a log out of the S&P 500, okay? So when everybody's sort of losing their jobs, about to lose their jobs, like here, the unemployment rate when the market was at is really high in 2007, the unemployment rate, you can see it on the left axis, was a 4.5%. And then the market plummeted and the unemployment rate was at 8%. And then the unemployment rate continued to move up until 10%. And then it peaked here, and about that time, the U.S. stock market had already risen with about 60%. That's if that should be correct, yeah. Yeah, that makes sense. Yeah, maybe 30%, 40%. Key point is this: when things are really looking bad, that's usually when it's time to buy, and when things are looking really, really good, it's usually time to sell. Now, using this as an indicator of selling, I'm not sure that would have helped too much, but you can definitely see here. And again, here, this is in 2000 and around the millennia, so the year 2000. Stock markets peak, they go down, down, and down, and then stock markets had a decline of 50%, and then the unemployment rate had risen from 3.7 to 5.86%. And then they continue to rise a bit more, and here you can see the actual low in the unemployment rate was when the market finally started to trade upwards. In the 80s, you can see that it's not as a good correlation. The reason I think why it wasn't such a good correlation in the 80s is because between, if I remember correctly, between the 70s, you can see here, right? From the 70s up until 82, the market for about 10 years was rather range bound. And you say, well, actually, Alex, no, it wasn't range bound because the market was going upwards. However, if you adjust the stock market for inflation, then you'll see that this was indeed not going upwards. So let's see if I can actually find an index. Don't remember what's called in this system. economy. Okay, there we go. Let's see if I can do this. I'm not sure I can. Yes, I can. All right, look at that. So, to not complicate things too much, let's hide this for a few minutes. So in the 70s, what happened is that you had high inflation, low economic growth. And if this is correct, which it should be, and now suddenly you can see data here from 1948. You can see how the stock market rose by 418%. And then from 68, the market declined with 66% until it found a low in 1982. So even though your chart without the consumer price index looked like it was in an uptrend, because the prices of everything else in the world at that point were going upwards. Gold, I think, it hit like its all-time high around in that decade. In fact, stock markets were losing. So from 66, 68 up to 82 was losing period of time. And then you had that crazy bull rally from 1982 all the way up 735%. And then what's quite interesting is that when in 2009 you could buy the stock market at the same level as it was in 1994 and pretty much the same level as it was in 1968, obviously at its high. And now you have that massive rally, right? And also here from the year 2000 up until 2014, so that's 14 years. So 14 years. If you would have bought at the high, you would need to wait 14 years to get your money back. Anyway, let's see if we can load that unemployment rate. And now, I guess it does provide slightly better input. You can see here in 73, the stock market was declining on a real adjusted terms, and then this was going upwards, right? The market peaked, this one went up, and then the economy improved here, the unemployment rate improved, but we didn't see an improvement in stock markets. And then you had that massive move with the unemployment reached what looks to be 17%. And then from the 17% high, from that maximum, the market bottoms out, and then it just improved like that. But I think what happened here in this episode from 85, that the economy had been so bad for so long, stock markets on a relative basis were massively oversold. So I think what happened at that situation is the people didn't really care too much, because it was more about the fact that you could buy the market at such a big discount. Because something that was striking to me in 2009, because I did actually buy at the lows. I didn't keep it for that long that I should have, but I did buy at the lows. And the thing is what's interesting in 2009, that the market was back in same levels as 1993, 1994. So we just need to ask ourselves, because this is supposed to be a representation to some extent of the economy, because corporations belong to the economy. So we could ask ourselves, doesn't it make sense at all that prices are down at levels from 1994, like if nothing had happened in the world, in the economy? Isn't the place wasn't the economically and resourcefulness wise, were we not in a better state in 2009 as in 1994, and possibly even 1968? Of course we are. We got better cars, we got better planes, we got better houses. Everything was new because we built so much in the boom, right? So everything was, much different than before, much better than before. So obviously you had a bit of a discount. And we'll see now what happens here going forward. Are we going to have a massive slide? Well, we could have a massive slide. But surely, of course, traditionally you'll have, I'm just going to get rid of the unemployment rate. So there we go. Traditionally, you will have maybe like a 30% decline. So that will sort of push you back to levels from December sorry, 2013, December 2013, which would be the same level as the highs here. But then you need to ask yourself, hasn't things changed to the better? Not really sure. Well, what if we have a 40% decline? Well, we have a 50% decline. That means we're going to go back down to these same levels here. And then you need to ask yourself, okay, we were actually, I know we were in a bubble state, but that would be technically same levels as 1997, same levels as the year 2002, and sort of same levels as 2008 and 2011. So then we need to ask ourselves, maybe the market would exaggerate. I mean, here the market slipped with inflation adjusted 60%. Here it declined with 50. So in a major bear market, 50% wouldn't be a big issue. Okay, we have Nikos here. Good morning to you, sir. I hope you're doing good. All right, so we don't have any questions. I think we're going to wrap things up. We took a little bit of deviation, a little bit more sort of historical, educational stuff. It's really important to know what's happened in the past. It's really important to know the big things that affect the markets, because sometimes we all get bogged down in this sort of short-term scalping and trading. But if we really know about our past and what happened, like the big trends, it definitely helps us to understand where we might be heading in the future. And as you know, the market's of course a bit quiet today, so we decided to go more that educational route. As well, as I suggested a few days ago, you had Ray Dalio. Ray Dalio is a billionaire, and he published this book that explains about big debt crisis. I started to read the first few pages. It's possible to buy the book as well if you wanted to, but you have the full book here as a PDF. He's sort of giving back to the community. And if you're somewhere, if you're having some time off, things like that, or if you don't have time off, I think it can be good to read up on that and sort of learn a bit more. He's done a great job analyzing a few major crises and tried to create some sort of a model so we can use that to understand the world economy better and hopefully trade better. So check that out if you haven't. I started reading, as I said. I'm going to be taking some time off in September for about 2 weeks. And I think at that time I'm going to try to go through the whole book. Okay, guys, thanks so much for watching. If you have any questions for me, as always, you're most welcome to reach out to me. You can reach me via my WhatsApp. You can also reach out to me via email. You can reach out via info@investingcube.com, and you can also send a message here via WhatsApp. If you send a message here, I will add you to my list. If you don't want to be added to my list, just let me know. All right, guys, have a great day, and I'll see you guys tomorrow, same time here at ATFX. Thank you, and see you tomorrow. Bye-bye.